Good afternoon. My name is Zenyatta, and I will be your conference operator today. At this time, I would like to welcome everyone to the NSP Q&A webinar conference call. All lines have been placed on a listen-only mode. Later, we will conduct an interactive question-and-answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. You will hear a tone acknowledging your request and a prompt to record your name. If you would like to withdraw your question, press star and the number 2. I would now like to turn the call over to Ms. Dionne Roberts. Ma'am, you may begin your conference.
Thank you very much, Dana, and good afternoon, everybody. This is the NSP Open Forum question and answer. So good morning and good afternoon to you, and I hope you all have brought your questions with you. This afternoon we have with us our HUD experts who are going to be speaking to all of your quandaries. We have John Laswick and David Noguera from HUD, as well as Hunter Kirk. I myself, Dionne Roberts from TDA, will be moderating this session and making sure that your questions that are in the queue get asked. And then Kathy Kaminsky from TDA will also be working with us to make sure that that happens. And David and John have a couple of comments that they want to make before we get started. But before we do that, I would just like to ask Kathy to go over the process for how you actually ask your questions.
Thanks, Dionne. So today we'll be taking questions in two ways. You can ask a question through the conference call, and to do that, you can first change your status and live meeting from green to purple. Up in the upper right-hand corner, you'll see feedback and a little green box. Probably green right now. If you click next to that, there are different options. You can also let us know in that box whether you're having difficulty hearing or anything like that. So you can change it to purple to let us know how many questions are in the queue, and press star 1. And Zanetta will help us manage those calls. She'll also remind you later how to ask a question verbally. And you can also ask a written question via the live meeting client. Up at the top of the screen, you'll see a Q&A icon. If you click on that, a box will open where you can type in your question. Once it's typed in, you can click Ask, and we will read those questions aloud and go through those as well. So we'll rotate back and forth between written questions and the questions on the conference call throughout.
Great, thank you. We have, in addition to that, just the information related to the resource exchange, so we want to remind you that there are a lot of resources available to you in addition to the HUD staff. And at this time, I would like to go ahead and turn it over to John.
Thanks, Dionne. Hello, everyone. Welcome from your nation's capital, where today it's 100 degrees and humid. So if you're out there on the bay or someplace, or next to the pool, save us a margarita. So we have a small-ish crowd, but a dedicated one, I know, and some of the TA providers, so hopefully we'll be reaching people. We don't have a number of general announcements. We have a couple, and then we'll just be open for your questions. We will announce the questions in a way that only refers to you by first name, I think, when on your written questions. So those of you who may be a little shy can rest assured that you will be remain incognito for the question period. So a couple of things that we've been hearing. We've just finished our last of 8 problem-solving clinics that we've held around the country, and we're up in Detroit last week, and have been, trying to answer questions and sort of pick through issues as we go, different issues in different places. Paul Patterson had noticed that a lot of people were asking about NSP 1 and 3 amendments. I think most people are aware that NSP 2 amendments have to be re-rated through the headquarters office, but if you want to amend your NSP 1 or NSP 3 program, you work that out as a action plan amendment in the same process that you use through your consolidated plan with the various notices to your constituents that are posted in the notices, in the relevant notices, generally 15 days notice to people. But and then you work those out with your field office. So if you need to add a census tract or subtract a couple of census tracts or change some activities, if it makes sense and your citizens support it, then you talk to your field office and you just work through that process. It shouldn't take very long, and as long as you've got a reasonable approach, it shouldn't be difficult or shouldn't meet a lot of resistance. There may be some times when a question comes up and the field offices will get us involved, but typically that's something that you can just do locally. Last week we had a lot of questions about disposition, the Upper Midwest, and other sprinkles of other places throughout the country really are acquiring properties and demolishing buildings on them and then trying to find subsequent uses for those properties. It's cleanest if you can demolish a property without acquiring if you can demolish the building without acquiring the property. But if you do have real estate that you've acquired through this process and you don't have an obvious next step, we are very close to releasing some guidance on this. Then I know that our faithful followers will remind us that we've been working on for over a year, and it's gone through a couple of different iterations, and I'm not going to get into the particulars because it gets confusing. But here's what I can tell you. I believe that we will have a relatively simple and painless way to meet a national objective and conduct an eligible activity with those properties for 99% of those. That we're coming up with a couple of different approaches, and I just want to tell you today, without getting into the particulars, that I really feel confident that this is going to be less problematic, less frustrating, less difficult than you might have thought at some points. And so I just want you to focus on getting your program moving, keeping your program moving, spending that money, and we will shortly be issuing that guidance, which I think most people have been sort of waiting for the closeout guidance for this information, and I think this is even going to precede the closeout guidance or the closeout notice. And I think that one is also going to be pretty straightforward because we've said this a number of times, but your program doesn't end at the expenditure deadline. If you meet your spending deadline, you probably have and will continue to receive program income. You will continue to use that as long as you can, and only when you have really completed all your activities and gotten your houses occupied will you then be ready to close out. Up until that point, it will operate 100% like it operates today before the expenditure deadline, and then after the closeout, it will operate about 90% the way NSP operates today. So it will retain its character as NSP, and you will still be able to do new construction. You will still be able to serve people up to 120% of median income. The only thing you won't be able to do is buy more land for your land bank, and you will not be, as we are proposing it at least, you will not be required to set aside funds for families below 50% of median, just because it's a little hard to keep track of a moving target. On another subject, we had a webinar about a month or 6 weeks ago in which our colleagues from FHA talked about their program, and we spent a lot of time talking about loans that exceeded 100% of combined loan to value. And as a result of that, we have been looking at that question, and it's not written yet, but it will be soon. So a very simple policy that says that that HUD is not opposed to that. as long as you're doing good underwriting and not putting these borrowers at risk of further personal liability for these things. So with the soft seconds and the other forms of financing mechanisms that you've used, it's probably we think there's a way to do that and maybe go a little bit over 100% of combined loan to value without endangering the financial stability of the family. So that should be out pretty soon. Yolanda is interested in getting that out, and if I hadn't been in Detroit last week, it'd probably be out this week. So we'll get that out next week, I promise you. And then I think the disposition, Jennifer's working on a piece that she's had really pretty complete for a while, and we're putting it into a little bit of more of a legal framework that our general counsel has done, and so I think that's going to be out pretty soon as well. So that's where we are. And David, did you have anything on your mind? Okay, so we'll just open it up for questions at this point then.
Again, ladies and gentlemen, at this time, if you would like to ask a question, please press star and the number 1 on your telephone keypad. Again, that's star followed by the number 1.
And as a reminder, folks, you can also ask a question using the live meeting client, using the Q&A tool that you'll find at the top of the page. We'll open up another box, and you can type a question in there and click Ask. Are there any questions on the line at this time, Zanetta?
There are no audio questions at this time, ma'am.
Okay, so we have one written question that I will go ahead and read aloud. It is from Marcia, and the question is, we are in the process of building new homes. If the total cost to build these new homes is $100,000, including land and construction, and the new homes were to appraise for $150,000, can we sell them for the appraised value of $150,000, or are we limited to selling the homes for $100,000 since it only cost us $100,000 to build them?
Yeah, that's a question that comes up a lot, and the answer is that you have to sell it for the lower of total development cost or appraised value. So in your case, that would be for $100,000. Now, we were up in Michigan last week where the opposite is happening, so consider yourself lucky. But there is a way to ensure that there's not a windfall profit, and you're required to maintain the affordability of these units for 5 to 15 years, or new construction 20 years, and you really don't want to hand just $50,000 worth of pre-equity to somebody. So typically there will be a second mortgage put on the house for to ensure that they can't sell the house right away, and if they do, they have to pay back some of the funds that they received. Now, in this case,
it could come in the form of a forgivable loan, right?
Right.
Or I know we talked about shared appreciation.
Right. I think in this case, shared appreciation is the way to go, because you have this chunk of value that you're not really directly. Well, I guess I don't know if this is a direct benefit or not, but you can get in on the upside of this and allow. For example, you could get 90% of the value if they sell it in the first year, and 80% in the second year, or 95 and 90 and so forth, all the way through. Or you could scale it a little faster or a little slower. But you want to be in a position to do two things: one, to keep that family in the house and keep that neighborhood stable, and two, to recoup some of the investment that you have in it. And we have some guidance up on this on our resource exchange, and there's a policy alert on home ownership programs that we wrote a while ago that you can look at for more details on how that works.
Great, thank you. Zanetta, are there any calls on the line at this time?
Again, I would like to remind everyone, if they would like to ask a question, please press star 1 on your telephone keypad. Again, that is star 1 to ask a question.
And there's no one on the line now currently, correct?
No questions at this time.
Right. So we don't have any written questions either. So David and Hunter and John, I'd just like to ask you to maybe speak to something that came up a lot in some of the problem-solving clinics that we did recently related to sort of the how and why of amending your target area. I think we have a lot of folks who were presuming that in order to do that, they would have to move heaven and earth, and that it would be much more complicated than it may necessarily be for them. So if you wouldn't mind just sort of, the 30-second version of when they should really think about doing it and how hard it really is.
Well, so for amendments in NSP2, it is a little bit more time-consuming, and we're running, I think, but from our turnaround time is about 30 days, and I think that's been pretty consistent for the last year or more. But before that, you have to go through your citizen notification period, and chances are you have to go through some sort of a board or city council approval, so that might take a little bit of time. For the local or amendments in NSP 1 and 3, you don't have that 30 days at HUD. You might have a week or 10 days at the field office, but that can overlap with the time that you're talking to your city council and so forth. You tell your NSP rep or your CPD rep what's going on, and they can say, oh, that makes sense, that sounds good, just keep going. So there is not necessarily any extra time on that side. But I would still say, even if you have to go to your own council, you're probably looking at a 6-week period, I would guess.
And for 1 and 3?
That's for 1 and 3. So when? Well, so you have to amend when you are changing the scope, location, nature, beneficiaries of your program. So anytime you're changing areas, neighborhoods, anytime that you're changing the program, the things that you're going to do, you can switch. We have allowed a fair amount of sort of reallocation among eligible uses or eligible activities. So if you've got all the eligible uses, you have financing mechanisms and acquisition and rehab and land banking and demolition and redevelopment. We have not generally required an amendment if it's if you have all those and you're just changing the budget amounts basically. But if you're going to eliminate a whole activity, or you're going to add a whole new activity, or you're going to move out of a neighborhood or move into a new neighborhood, those are the kinds of things that would require an amendment. And if you're not sure, just call up your CD rep and they can tell you.
The other thing I'd mention is that with NSP2, it's a little more restrictive than the regulations. Because it was a competitive award, it's important that you look at the most recent application or amendment that you have on file to see how the changes that you're making impact that application, right? So, for example, if you said that X number of units were to be used for rental properties, and now you're moving away from a multifamily model to a single-family model, right? Well, under the traditional rules that may not trigger an amendment, but under NSP2 it probably would, right? So you want to take a close look at the application you have and make a determination as to whether you want to submit a request for amendment.
If you have any questions, ask.
Right.
Any doubt, just ask.
So, Dion, were there other things you were picking up at the clinics that you thought were I know that there were a lot of questions around subrecipients and developers. There continue to be. It doesn't surprise me. It's a complicated area. Stan Fitterman and some others are doing a webinar next week, I think.
A week from today.
And that was coming up a lot. If you're confused in that area, we can deconfuse you. Our special offsite technical assistance, we can get 16 hours of remote TA to you within about a week in terms of a turnaround period. We also have published some additional guidance recently, about a month ago, early June, on subrecipients and developers and procuring subrecipients and developers and what they have to do to follow procurement. It's been a kind of a confusing area for a lot of folks, so we're hoping that policy cleared that up. Sarah Stewart in our office did most of the heavy work on that.
Okay. Great. Thank you, John. We actually have a follow-on question related to changing target areas. So I'm going to ask Kathy to read that one.
Sure, thanks. So this one is related to amending the target areas in NSP3. Merrily asked, does the grantee have to use the mapping tool? And if so, has it been updated with new market data?
Yes, you do have to use the mapping tool, and no, it hasn't been updated yet, but it will be updated shortly. And if there is, if the grantee has accurate, newer data, that suggests that a block group or a census tract or a neighborhood has gotten substantially worse over the last year, for example, and this is happening in some places. We can look at that, but we would really rather do it through the mapping tool. It's easier, it's more consistent, gets into a little bit of strategy because I realize that some of the hot spots have moved from the middle of your target area to the edge of your target area or perhaps beyond that, but given the amount of resources, there's still a lot to do in the original target areas. But if you've got a reasonable rationale for doing it that way, we've been pretty open to considering those.
Great. We have a couple of more questions, and then we'll also check the phone lines to see if there are any there as well. The next question comes from Mark, and the question reads, once you have acquired a single-family residence and the grantee receives a refund check at the close of escrow, is the check the PJ receives considered program income?
So the check that I'm assuming you're talking about would be from the title company, which would be sale proceeds. So let's pick an easy example. You spend all the acquisition and all the rehab costs on the unit, so it's 100% paid for with NSP. You've got $100,000 into it. You've got a $30,000 worth of soft seconds and closing costs and everything, and you've got a $70,000 first mortgage from your local community lender. When the loan closes, the lender pays $70,000 back to the city or the grantee, and that is program income. So you would want to look at the program income guidance that we put out just about a year ago this time. There's a policy alert on program income. It's a little bit complicated, but to go into all the details, you can follow up. But that primary amount of money is program income. The only exception to that would be, let's say you paid, they estimate some of the closing costs, and they say, well, we think that that this agency is going to charge us $90, and they only end up charging you $65. So there's a $25 payment. That actually is called what do we call those things? applicable credit. It's a credit against your account. So basically it means that, you paid more than you had to, and this happens all the time, and it's usually small amounts of money. Technically, that's not program income because, in effect, you never spent that money. It goes back into your account, and it acts like program income, but you can't take 10% admin on it.
Right. You treat it as program income.
But it just goes right back into your account. But the big number, the $70,000 that you get back from sale proceeds, that's going to be program income. And that you can use, and you have to use for other NSP-eligible activities that meet a national objective. And that money gets spent, that stays in your account and gets spent before you make another draw. So you go through any program income before you draw funds. It counts as if you'd drawn it, though, so you're not hurting yourself by getting program income and spending it first.
You just have to make sure you're tracking it in DRGR so that we can follow, your trail.
I would say that we, just between NSP 1 and 2, we've seen about $670 million worth of program income already through early this month. So that's almost 10% of the total that we've gone through in those. So actually a little more than 10%, and we're expecting that to rise to maybe 30, even 40%. So if you're thinking about how you keep your program going and how you continue to, do the work in your NSP neighborhoods and combine it with your CDBG and home funds, given that depending on the type of program you have, you could play that out for quite a while because that'll come back and you'll use it again and again.
Great. Thank you very much. Why don't we check in and see if we have any folks on the phone? We have a written question, and it's a great question, but I think it's going to generate a lot of discussion, so I want to check in and see if there's anybody on the phone before we get to that one.
And we do have a question from Rebecca.
Okay, great.
Yes, can you hear me?
Yes. Hi.
Yes, I just want to clarify because I've heard two different things. We're using the recapture method when we sell our rehabilitated houses.
Uh-huh.
As an example, we have a house that cost us $80,000 to rehabilitate. The appraisal came in at $70,000, so we sold it at $70,000.
Right.
We're offering a soft second of $14,000, and that's what we're using. That $14,000 is what we're counting as the affordability period.
Right.
So it would be a 5-year affordability period. Someone told me that I needed to count that $10,000 in the cost, that needs to get rolled in there so that there is
No.
a longer affordability period, and I did not understand it that way, so I wanted to make sure I'm doing it correctly.
Yeah, the difference between the cost and the appraised value is considered to be a development subsidy, and it's money that's just sunk into that project, and the family doesn't get any benefit from it because the appraised value is only $70,000. So there is no affordability period required because of that $10,000, and it doesn't get added to the $14,000. So in general terms, what you're describing is correct.
Okay, great. I just wanted to make sure because I had gone to a training and somebody was saying that we had to count that whole development cost in, and I'm thinking, wait a minute, we're doing recapture. We're a city. We're not developers. So,
yeah.
Okay, great. I thank you for clarifying that for me.
As David points out, if you're in the resale model, you count every dollar that went in into that, but you're not doing that. So.
No, we're doing the recapture. So.
And most people are.
Okay. All right. Thank you so much.
Yeah, there's some guidance on that in that home ownership assistance piece. So if you want to read some more.
Okay, I'll pull that down. Thank you.
Your next question comes from the line of Karen.
Hello.
Hi, how are you?
Great. I am with the state of California, and we have had the redevelopment agencies go away, which has had an impact on several of our projects that the funding has gone away as well.
Yeah.
My question is the only way to basically shelter these projects to let them get more funding lined up to basically offset them with program income so that we are not in a position that that expenditure is a problem? As long as we offset those numbers by program income received, then can we kind of like protect them? Does that make sense?
Well, how did they get into your program? I'm missing a step here. You know, they most cities, as I understand it, picked up these properties from the redevelopment authorities or cities or counties. Is that correct?
Well, one specifically that I'm thinking about purchased the property with NSP money.
Okay.
And then they were going to do redevelopment with it.
Okay.
But the redevelopment funding that they were going to put into it from their redevelopment pool obviously has gone away.
Right. Well, I think the first question that you're asking is about expenditures. You still have to, spend 100% of your grant amount, either directly or through program income. And so, you're not going to be able to sort of bank any of your program income to assist that property directly. And I guess the only way to really sort of protect it in a little bit longer run is to have it in a land bank, which doesn't have to be a formal, separate organization. It could just be part of the city or something like that, and that would give you more time to deal with it. But those properties are supposed to be land banks are only for foreclosed residential properties, so that might not.
Karen, are you looking to buy time or to generate revenue?
Predominantly just to buy time for them.
Okay.
So to buy time to come up with the rest of the money and...
Yeah, to let them go out and try to look at other sources.
Well, all right. So let me see if this starts.
Deadline.
Yeah, you meet your expenditure deadline. You're then going to continue to receive program income, which can be used to redevelop a property like this. You might even want to get into something like a revolving fund, set up a separate fund for program income to be channeled into for a particular activity, and then this would be maybe the only activity, so that you could sort of build up a little bit of an amount of program income that wouldn't have to be drawn and spent on other projects first. You'll still have, I would say, probably 2 years, a year and a half to 2 years after the expenditure deadline to, before we're really looking at closeout. There isn't a specific deadline for us to close. So if there's a good reason, we could kind of keep things open for a while. Does that start answer? Does that?
Yeah, that gives me a little bit of direction.
Okay. And
thanks.
If you want to write in and kind of, or call us or whatever. You have. I think Rebecca Blanco was a good source over there.
Absolutely.
For those kind of things. But yeah, I think, you will have some flexibility is what it boils down to. How you structure it and when you need the money and how much you need and everything and what your program income stream looks like really varies. It broke our heart to see some of these properties in Michigan last week that they've got $225,000 into them, and they're historic, gorgeous houses, and they're appraising for $60,000. So, so their program income stream relative to the need is puny. But a lot of other places, they're getting pretty good money back on what they spend. So, I would think that'd be true in at least in some California cities.
I thought what you were initially saying from the loss of the redevelopment funds, though, was that you weren't going to be able to carry out all the projects that you had expected because you had this gap, and I guess I was thinking that the NSP funds wouldn't be sufficient to fill the gap. So You wanted to buy time to save NSP funds. Was it something like that?
Well, most importantly, what I want to do is I want to buy time so that the jurisdiction doesn't have to repay the monies that they've already expended without being able to have beneficiaries to report.
Right, right. Well, I mean, you know, we've talked about closeouts and stuff, and I mean, it's even conceivable that we could close a project, you know, subject to, you know, final occupancy or something. I don't think we don't really want to do that, but I think there would be some ways to kind of, you know, structure that so that you'd have some ability to achieve those objectives and not have to reimburse the program.
And occupancy isn't what we're looking for in the expenditure deadlines next spring, just so you're clear.
Right, right.
But yeah, every one of those is a little bit different. So, you know, Karen, write it in or call Rebecca or call us, and we could kind of play through the details a little bit more.
Thanks.
Sure.
Great, thank you. So on to the mystery question. I think this is going to be, there's actually two questions that are related, and they both relate, guys, to how to determine if somebody is really income eligible and how much you should worry about things that you see in their documentation. So in the first example, so these are not regulatory issues. These are more of the squishy stuff, which is why I think they're going to be fun. So the first question is from Paul, and the question is, do you have any quick thoughts on how far one needs to go in questioning a buyer's finances in the event that they sign an income verification form indicating sources of income and showing that they would be income eligible, but they have numerous deposits on their checking account statements that seem to suggest that they might have additional sources of income that aren't being reported? So how much sleuthing should go on?
Well, so I guess one thing that kind of triggers a question for me is, you know, when you say verification, because while we can't sort of strictly prohibit you from self-certification, for a benefit of the size that most of these NSP properties convey, we would typically be looking at a much more rigorous type of income verification process, either through the tax, you know, the IRS forms or the census long forms, or for the everybody's favorite Part 5, which is a very complex and detailed evaluation of income and assets and all sorts of things like that.
And John, just to clarify, I think from what it's saying, it looks like they're actually doing that. I guess the question is, if on the form they fill out and they provide documentation that verifies the form information, but then when you look at their bank statements, which they've also provided, it's showing other money that's not on what they've said.
Right. Well, I mean, you certainly need to ask about that. I think that's fair game. I mean, if the person's provided information that's not corresponding to some of the statements they've made or the forms they filled out, then they need to explain those discrepancies. I mean, I remember the first mortgage I ever got, the bank said, well, wait a minute, you missed a rent payment back in, 2 years ago. What was that about? And I said, well, my wife's had an automatic deduction, but she worked for a university and she didn't get paid in the summer, and we didn't realize, it's a one payment. Yeah, so yeah, I mean, we got to get it out there.
Great, thank you. And so the next question actually is just a different situation, but it's the same issue of when do you raise the red flag. So in this instance, and this question is also from Paul, he's saying, for buyers moving to the area from out of state who had several income sources out of state, but indicate they'll only have one source of income now, 2 adults, 1 income source, as opposed to 5 or 6 income sources previously, does this raise a red flag? If so, what advice do you have?
Well, there's probably people on the line that know more about this than I do, so I'd invite them to call in. But, I mean, there could be any number of reasons that, you had to have 4 jobs back in Indiana because you couldn't get a full-time job. You and your spouse were both working 2 jobs, and they were both kind of lousy jobs, and then you got a decent job in a new place, and that's what you intend to do. I can imagine that there's reasons for it, but again, I think you need to ask the question and you get a credible answer. I don't think you should sort of assume that everybody's trying to cheat you, but but I think you have to be careful. I mean, this is public money. Mistakes happen, but you also don't want a whole bunch of mistakes to happen and end up on the front page or in court or anything. So, but I think that it's fair to ask these questions, but I also would really caution people not to jump to conclusions because there a lot of times there's good explanations for these, and the only way to get those explanations is to ask the people that are going to become your customers.
Thank you, John. And I think that's a great point. There are underwriting guidelines, and there are examples of them available on the website and the Resource Exchange that talk about what your criteria are. And in many underwriting guidelines, it also says that, you can ask for additional documentation. So you may, have to ask them to document where those other sources came from. Copies of the checks for those deposits in that first example, things like that. And, but at the end of the day, if they're willing to sign a form under federal law that says that they're not committing perjury and they're telling the truth, you want to make sure that they're aware of that, but circumstances do change. And Maria just sent in a quick note that actually is a great comment saying make sure that they make a distinction between income eligibility versus financial or creditworthiness, because very often what you'll see, and this is a great way to double check when you worry about those red flags, is if you get the mortgage package that they submitted to their broker to get their loan, very often, they're trying to up-qualify on that side and down-qualify on the income eligibility side. So if you are going to find discrepancy, very often you can find it by comparing the pieces of information that have been provided for each, because they are really 2 separate things in terms of whether they income qualify for the program itself versus whether or not they're actually creditworthy or can qualify for a first lender or under your underwriting criteria.
Good point. Yeah, I agree. We do have just as a side note, we are developing an income verification tool on the internet that will be for all of the CPD programs, and it will use the Part 5, the complex set of questions and assets and liabilities and income and so forth, and that should be up in about a month, I think. We'll see. Maybe end of September. So, just because that's kind of, that's the most detailed approach, and I'm not necessarily sure that means it's the best, but if you use that, and most people like that, it's kind of hard to handle all the variables. So this should make it a lot easier.
Great. And Janetta, can we check if there's anybody on the phone lines?
Again, if you would like to ask a question at this time, please press star 1 on your telephone keypad. And we currently have no questions in the queue.
Great. So we are questionless at this point. I wanted to go back to something that you said earlier, John, related to the deadline issues that folks are looking at coming up, and the fact that there has been a lot of confusion related to what the expectations are at closeout versus what they are at the expenditure deadline. And many people are thinking of those 2 things being the same thing, and they're assuming that on whatever their expenditure deadline is, that also means that they have to have all of their national objectives met and their beneficiaries in place.
Yeah, and that's definitely not the case. It's an expenditure deadline, and there is no set deadline for achieving, making all the accomplishments that you've proposed to make. And we know that in many cases, we talk to people all the time that have projects that are just going to construction this year, and they'll be, if they got other sources of funds, they may even be under construction past the expenditure deadline. The NSP funds will be spent, but they won't even be, able to be occupied until, maybe next summer. So what we're looking at for closeout is for projects to be occupied. We want to see that you've met a national objective with all of your funds. That's a little easier to do with demolition, but when you get into housing, particularly rental housing, there's long lead times, and so you just have to meet your expenditure deadline. And let me repeat that you have to spend an amount equal to your grant, but if you have program income, you're required to spend that first. So you may go through program income and still have money left in your line of credit. But if you have spent, program income and drawn from your line of credit in an amount equal to your grant, you will meet the spending deadline. But that means you'll have money left in the bank, in effect, next spring, and you can keep using that. That will, that's basically your program income. So you can continue to spend that and continue to receive it and re-spend it. And it makes sense to kind of think about how, a number of grantees that are thinking about this, I think, have done a good job of, really estimating, well, I got this multifamily project, and when that gets taken out in permanent financing, I'm going to get $1 million back, or I know that I'm selling one house every 2 months, and I'm netting on average of $50,000, and so you can give yourself sort of a rough calculation of when and how much program income you're earning, so that you can kind of lead yourself to a soft landing as far as how long can you keep staff on, and how much work. There's a certain level of activity that you kind of go below, and it doesn't really justify a full-time person or whatever. So, how's that going to work? And those kind of adjustments on top of all the, furloughs and layoffs and everything that we see across the country, it's going to further complicate that. But you ought to be thinking about that.
The last piece that I'll add to that is, as long as you have money remaining in your line of credit, you won't be closing out your program. Right? So, there's a number of factors that have to be met before you can close out your program, and that shouldn't get confused with the expenditure deadline.
Yeah, but I was telling the people in Detroit last week. It was a week ago, and we're looking at 7 months to the NSP2 spending deadline of February 11th, and then almost all the NSP1 and NSP3 grants the NSP1 has to be 100% spent. Most of those grants were signed in March, 3.5 years ago, and NSP3s were almost all in late February or March of 2011. So there's going to be a period where a lot of communities are going to be cranking to reach those deadlines. They still have money left from NSP1. They have money to spend from NSP3. We are starting to take a look at all of those and make sure that the ones that are having problems are getting assistance directly from people like Dion and others who are capable technical assistance providers. So, be aware that, not a majority, but certainly a large percentage of NSP grantees have received some form of technical assistance. It's not a stigma. It's not a sign that you don't know what you're doing. It's, in my opinion, it's a sign that you do know what you're doing if you need help. So don't be afraid to ask.
Thanks, John, for that, pitch. I appreciate that.
Okay.
I have one comment that came in related to the conversation about qualifying folks, and then another question that's come in. Amy mentioned in relation to the previous conversation that they actually have a form, and I love the name of it. It's called Affidavit Concerning Truthfulness of Documents Presented, which I think is really clear. And apparently they require the buyer to sign it during their closing process as well as during their housing counseling process, just to sort of reinforce the idea that, this is a federal process.
That's right.
And you got to make sure you got all of your stuff in. We do also have a question that's come in from Leslie, and it's a big one, and it's talking about disposition costs and the interpretation of those costs when they're carried out by developers.
Okay.
So I'm going to read it, and I may have to reread it for you, but here's the question. It says, in the Disposition Strategies Workshop slides presented at recent clinics, on slide number 4, it states disposition must be carried out by the grantee or subrecipient directly, not developers, to ensure compliance. And then it lists certain items, including ongoing site security, boarding up, security system installation, marketing property for sale, taxes, insurance, maintenance costs. And then there's a citation that is 24 CFR 570.201B. And then the question goes on and says, however, many developer agreements include some or all of these costs and are carried out by the developer. If you look at the NSP analysis template, you can see that all of those disposition costs are included. Is the selling of properties by a developer not called disposition per se, but considered sales, and therefore doesn't fall under this rule? So I think what Leslie's asking, is this a question of language?
Right. I think
we're calling it disposition, but it's really not disposition under that particular regulation.
Yeah, I think that's correct. And in fact, I had this problem with one of these slides myself. So, sometimes we've said that, well, when developers do it, it's not, developers can't do this. Well, it's not that they can't do it. It's that when developers do it, it's not disposition, or it's already included in total development costs, or it's included in their fees or whatever. So it's not a separate cost. Like a cleaner example is activity delivery costs. Well, if a city or a subrecipient nonprofit, charges to develop a project and to income qualify people and to do the inspections and so forth, those charges are considered to be activity delivery costs. If a developer does them, they are part of the development costs, and they get paid for them, but they don't get paid, by the hour. I mean, they're calculated and they're estimated, but once you've agreed on a price, then that's what they get for them. So I think that's the same thing is happening here, where disposition is developers dispose of property, but they can't charge extra amounts on top of their development costs and fees to do it.
Right. And it's also not reflected in the total development cost calculation, right? These are very the developer gets a percentage, a fee based on a percentage of the total development costs, right? And you certainly don't want things like cutting grass or other forms of maintenance that come with disposition to be racking up that total development cost, right? Those are just extra activity delivery fees. So
they should estimate some of that in, I guess, at the beginning, but they don't get to come back to the bank and say, hey, I have these extra costs here. But yeah, I think it is largely semantics. And so it's just that, this is one of those reasons that developers and subrecipients are confusing, and why you want to listen in next Thursday to get into some of these nuances, because most of these things can be done by both parties. It's just that they're accounted for differently, and that's where you
compensation.
Yeah, you need to be careful.
Great. So it sounds like, John, this may be one of the topics on next week's webinar, as it relates to sort of how we use language differently to be able to achieve the same result.
Yeah.
Okay, perfect. Leslie, thank you for that question. There looks like there's a follow-up to that, and what she's asking actually relates to the last thing that was said, where it was the can't come back to the table issue. Obviously, we've seen some properties not sell, and folks have carrying costs that probably couldn't realistically be anticipated on the front end. And the question is asking if they can basically renegotiate the contract to take into consideration issues related to if they need to do marketing or allow for price reductions or additional carrying costs.
Well, I mean, you can. Is it a smart thing? Sometimes yes, sometimes no, I guess.
I think the key is to understand the difference between a developer and a subrecipient, right? A subrecipient isn't taking on risk. A subrecipient is carrying out a project for a grantee. So as additional expenses are incurred, then the subrecipient can be compensated for those. With a developer, what you're doing is hiring an expert, right? I mean, similar to when you bring one into your own home to carry out a project, right? Now, yes, up front you want to include some contingencies, but you want to watch how much you allow them to take this, right? So, for example, if the property is sitting on the market for an extended period of time, does that mean you allow the developer to be compensated over that period of time as they're waiting? Probably not, right? They're the one who brought the property to the program. You're looking to them for their market analysis expertise, knowing that that the property should sell. So that's not the kind of thing you want to compensate them for. I will say there's no black and white sort of issue here, but you do want to be mindful of how far you compensate the developer.
I think I'd have two sort of suggestions in this, and I agree with David. One of those is that most developers and most contractors in general should have some sort of a holdback in their contracts that allows the grantee or whoever's paying them to retain 10% or something. It's a kind of typical amount until the end of the contract, so that they don't get all their fee, and then they have no real incentive to stay in the project if things start going wrong. So you want to keep their attention by in effect keeping their profit in your bank account until you've got a successful outcome. And then I think along with that, I mean, I would be reluctant to renegotiate a contract without extenuating circumstances before the developer's gone through their fee, because as David was saying, I mean, they're taking a risk. They're betting that they can do this faster and cheaper and make more money. And so in exchange for that, when it doesn't go faster and cheaper, they're the ones that have to bear the responsibility to make up that gap. And if their profit goes down, that's what being a developer is about. So you should have an amount in the budget that gives you some room to make adjustments, particularly for rehab. And you should have a holdback so that when these kind of discussions take place, you've still got the upper hand. But I mean, I still think I wouldn't just reopen negotiations because the project has the property hasn't sold or whatever. I mean, that what you need to see is that there have been circumstances beyond the developer's control that created a problem that puts them in a bind. And that happens. So it isn't black and white, but don't just go in there expecting to solve all their problems.
In some cases, you may have selected a bad developer, and you may need to switch course there.
Now, when has that ever happened, David?
It only happens in California, I heard. So.
No naming names.
Oh, sorry.
We have another question, and this one actually relates to a document that's up on the Resource Exchange that's called the NSP Case File Checklist, and it's actually part of the Homebuyer Toolkit. And I'm going to see if I can somehow manage. No, it doesn't look like I can. I was going to say try and take over the screen here. But there's an item on there, and all it says, because all it is a checklist. And when I pull it up, there's a checklist, and the item, and it's item number 35, says buyer underwriting. And so the question is, what needs to be in that file? What needs to be in there that relates to that? And I think that's a pretty complicated question, depending upon whatever your own underwriting standards are and whether you're following Part 5 or 1040 or what you're doing. But I'm going to shoot that one over to the HUD folks and see. I don't think there's any specific criteria as long as it meets with their policies, correct?
For documentation, do you mean, or?
Right. Because the checklist, because it's only a checklist, just says buyer underwriting. So presumably that is to whatever their ratios are as opposed to home buyer eligibility.
Oh, right, sure. Yeah, well, I mean, I think that's what you should be doing, which is, looking at the credit scores and their income and, this whole income verification, but also, can they really afford a unit? And if so, how much can they afford? Because, just because you got a house that's got an appraised value of $70,000, somebody might be able to afford $65,000. Somebody else might only be able to afford $55,000. So you shouldn't be just, in general, you shouldn't be just, giving out the same amount of money to everybody. There should be some relationship between what you're offering, particularly if it's a large percentage of the cost, and what what they need.
So John, there's a separate place in this where it asks for income certification and verification. So presumably this is about exactly what you're talking about. It's not about whether or not they're income eligible for the home, but as Maria was pointing out earlier, it's really about, are they credit worthy and can they afford this particular unit? And so I guess, the one thing that I would want to add as a TA provider is that if you don't have a policy that identifies at least front-end ratios, if not back-end ratios, that's something that, HUD can assign one of the TA providers to work with you with remotely through the on-call TA.
Yeah.
But if you don't have that, you really should, not only because of the undue enrichment issue, but also because we all want to make sure that folks don't get set up to enter the same kinds of situations that created the foreclosure crisis to begin with.
Right. Well, I mean, many of those toolkits are, we looked at them. They're not sort of endorsed by HUD, but they can't hit every topic. But I think that most people, when you say underwriting, you think of the apartment building down the street and the developer and all that sort of bigger rental projects. But really, single-family homes and individual buyers get underwritten as well. And so I think that's just reminding people that they have to go through that process. Now, hopefully, there's someplace in some of those toolkits there are more detailed steps in doing that. I'm pretty sure I recall seeing some maybe in a different handbook. So, but you've got to look. That somebody, you don't want to get somebody in too deep. You don't want to over subsidize them. So there's only one way to find that out, and that's to kind of look at their what they can afford and what you can afford, and see if there's a way to make those match up. But we also have, National Development Council has a continuing series of underwriting trainings, and the first one in the series that we're paying for is single-family underwriting. So I'm pretty sure we still have some of those going on through the end of September, and anybody who can afford the travel can attend for no cost. So those are excellent courses, and And as Dion said, we can match you up with somebody over the phone even and kind of talk you through a process that, it's not hard, but you just have to be deliberate about it.
Thanks, John. We have a few more questions, 3 more written questions that are in right now, but before we get to those, I just wanted to check and see if we have any questions come in over the phone.
We do have a question from the line of Alan.
Hello?
Go ahead, Alan.
Hi. Yeah, I'm just asking, hold on, I wrote it down, regarding administration as it relates to the deadline. My question is about admin expenditure as it relates to the expenditure deadline. Since administration of the grant is expected to continue after the deadline in terms of grant reporting, accounting, and also meeting national objectives, can the admin money be sequestered and drawn down after the deadline to do the proper administration after the deadline? That's my question.
Well, it's a good question. Not sequestered so much, Alan.
Yeah, I think that's not a proper word, but
right. No, I know what you're saying, but you can't kind of save it. But the way that you can save it, that's permissible, is basically to underspend a little bit on your administrative allowance, and then overspend on some activities that will generate program income, so that you can then receive funds after the spending deadline, and your 10% is going to apply to your total grant plus program income. So, if you spend the admin at a somewhat slower rate than you spend the activity funds, then you might be able to kind of balance that out a little bit, though.
The whole goal there, though, is to generate program income, because come next spring, when those deadlines are in place, we're looking at 100% expenditure, not 90%. Right? So it'll include the initial admin.
But you can create a sort of a credit to some extent. I mean, you'll have to earn program income, but you will still have some budget capacity for that 10% if you haven't spent the whole amount by the deadline. That's really the only way that I could recommend that you can do it. Although, if you're not running right up to the limit the whole time, and you have some projects that you can move out, and you're going to receive some funds after the deadline, then that should work out.
Yeah. The way our program works is it's not really fully designed to create a program income. It's basically more on second mortgage assistance program and a little bit rehabilitation. So we expect to acquire all the target numbers through the second mortgage assistance program, but we're also doing a rehab, which we think we should continue doing the rehab until we are done after the deadline. Right. So we can budget for the rehab going forward, but what I'm saying is the admin money, which we have budgeted at 10% right now, we might be only spend it at 7% level at that time.
Do you see income after the deadline then?
That's going to have to come out of that rehab money.
Yeah. How do you
rehab money?
Do you get that back when you sell the units then, or? Some of that?
No, we give the second mortgage assistance, and it will be silent there forever. The only time we get it back is if some kind of real estate transaction happens, then we collect our second silent. You know what I mean? So it's not really designed to create a program income like our NSP1 or NSP3, but it just will be silent. And actually, I have also a follow-up question. So far, we have helped close to 80 properties using this second mortgage assistance, and we've never had any foreclosure issue.
Right.
But down the road, if people move from California to Arizona, or if some unexpected event happens to them, they might foreclosed. So we were also thinking to put like a revolving money to protect our second mortgage investment. So instead of us being at the mercy of the first trust deed, who they're going to sell or short sell the property in order to recover their first. So we can intervene and buy out the first and recycle this home to another income qualified person. Is it possible for us to put together like a revolving loan to protect our investment, like 5% of our investment?
One problem with the revolving funds is that they are capitalized with program income. So even your program design, it sounds like that's not a great option. I mean, I guess the other thing I could suggest is that maybe you want to start, maybe you could start structuring your soft seconds in a way that you actually get some, they actually make some payments. I don't know, but that's probably not going to do. That's
it's
be a big
kind
number.
of too late in the thing. The only times our soft second will come to us is, like I said, if there is some kind of transaction, if the owner moves, and if we sell it, then we'll get our full second plus any appreciation, prorated appreciation, and so on. But if they remain silent and owning the building for 30 years, that's when we get our money back.
Right.
It's a silent second with no interest. So there's no program income generation capability here. But on the other hand, since a bulk of our money is sitting as a second, it behooves you put together a small revolving fund to intervene and do something to protect your second in order so that, to mitigate the risk and that you're not at the mercy of the first, because the first has the first. And all they care is to recoup their first. So at a time we need to intervene and buy out the first and then resell this property to a qualified income person who brings another first, and that first will replenish the money, the revolving money that we're expect. All along we planned this way, but I don't know if it's going to work with the deadline or if we are going to be allowed to draw down money and put it in a private revolving escrow fund. And I'm wondering if that's going to be considered as a spending or even if we're allowed to do that.
All right. Well, that's kind of a complex question, and we could talk about it a little bit more offline, or maybe we could even connect you with a financial specialist. But there is a thing called a loan loss reserve fund, which would be perhaps a different way of running your silent seconds that would allow you to have. But that actually kind of protects the lender more than it protects you. How much are your first mortgages averaging?
It's 50-50. Usually people bring 50% from the first, and the other 50 is from the silent second.
How much?
So what?
What would that be in dollar terms?
In dollar terms, I think our second is averaging about. This is Long Beach, California, about $140,000.
Yeah. Okay.
So we have like 70-something properties so far. So what we worry is if people default and if it's advantageous for us to intervene and buy out the first and recycle this property, that's it's more prudent to do it that way. But in order for us to do that, I think we have spent probably we're going to spend about $14 million when we're done with this program. So we're thinking if we reserve 5% of that, which is $600,000 to $700,000 in a loss prevention reserve or some kind of escrow, that really will help us. The good news is it's been 2 years now. We don't have any foreclosure, because we did.
I think the other thing that you've got to give yourself credit for is that, you're running a kind of program that doesn't get a lot of money back, but in exchange for that, you're doing a lot more units the first time out. Yeah. So I think that's just one of the trade-offs here. I mean, it may be possible to do some sort of a reserve fund. I don't want to say for sure, with this limited information, but we'd be happy to, follow up with you. But it's not. It's not out of the question. On the other hand, if you only have a couple of defaults out of 80 loans, I don't think that's going to destabilize your neighborhood either. So, some of those, you could go to all these lengths to try to prevent, to try to stay 100% perfect. It might not be worth it, in the long run, given that, you've already had this kind of stability so far, and, maybe you, but I don't know. It doesn't.
Yeah. I think the situation right now is we're hoping even if there is a default, the market will cure it, and we'll get our full second as a program income. But
where you are, that could happen. So yeah.
Yeah, but in some situation you don't know about the housing market. The first is in a position where they can foreclose it, and their aim is to recoup 100% of their money. And if NSP2 is going to lose money here in this kind of arrangement, the reason we're thinking about this fund is to protect the 14 million investment, so 5% would be a good amount that you can protect your, I don't know, we cannot gauge the future, you know what I mean, until 3-4 years is lapsed. So that's why all along we're thinking about this strategically. And actually we're putting together some kind of white paper to discuss about it. So I think that's a better way to send this idea to HUD in some way. And
maybe have you take a look at it. And we've got a sharp guy in our Los Angeles office named Elliot. He's a little overwhelmed these days, but those folks understand real estate pretty well out there. So I think between his office and ours, we could take a good hard look at it and see if there's a way we can make it work.
Okay. Thank you very much.
I will say, though, that if you're interested in generating program income, you may want to consider amending your program to offer other products besides soft seconds.
Get into add a shared appreciation feature, for example, instead of just get in a little bit on the upside of these things, so that you give yourself the ability. If somebody sells a house, and not a default situation, you get something back.
I think it's the underwriting is done that way right now. If there is an appreciation uptick in value, the appreciation is shared between us and the homeowner based on the infusion, the percentage of infusion in this whole. If it's 50-50, we share the appreciation 50-50 too. But the thing is, if they're stable and if they're staying in their house for the next 20 years, the money doesn't come to us. But on the 30th year, we get fully our second assistance. But our hope is to create a stable household. But in case if they move to another state or something, it will go out for sale, and hopefully the market will support for both the first and the second to get their money back 100% and plus any appreciation. That's how it's designed, but it's not.
Well, we're gonna, we'll take a look at it, and we're gonna move on to some other questions right now.
Okay. Thanks. Thank you very much.
Okay. So, John, is there a way that he should get in touch, or how would you?
Well, I think
to close the loop.
What I recommend is that you talk to Elliot in our Los Angeles field office, and then we're talking to him all the time. So
okay.
So I will put
That
together
sounds great.
something
Thank
and
you.
send it to him. Thank you very much.
Yeah, good luck.
Bye.
Sounds like you're running a good program.
Bye. Thank you.
So we do have a number of other questions that have come in writing, and then we'll check back with the phone as well. The next one is from Chris, and this is a little interesting. So this is a situation where there is a developer that is also the contractor on an NSP-assisted project. So construction management is a line item in the construction budget. And so the question is, would that line item, construction management fee, be considered the same as a project management fee, which has to be included in the developer fee per the policy alert on developers, subrecipients, and contractors updated November 16, 2011? Or is that considered to be separate than, would it not, basically, does it have to be considered part of the developer's fee or not?
It's my understanding that would be a separate fee. I mean, if you went to a third-party independent contractor, they would have a construction management fee, and sometimes you get a little bit confusing with the developers, but and sometimes it looks like identity of interest, but developers can have related construction companies, and construction companies can have construction fees that are different than development fees. I mean, the construction oversight is a different end of it than the development fee. They're two different functions. I mean, you can make it part of the same thing, but I mean, they're entitled to. Just because there's an identity of interest developer and contractor doesn't mean that the contractor has to give up the construction management fee, is my understanding.
So you can break it up, or you can consolidate them together. But at the end of the day, the total of the fees should be reasonable, based on market.
Okay, great. Thank you.
Pardon? Is that your experience?
Yeah, I mean, I think that makes sense, but I think the key issue is, as you said at the end of it, reasonableness. So if the developer's fee is already kind of at the maximum, and there is a clear identity of interest and some potential issues there, then you want to be careful about that. But as you said, John, there are situations where it's completely valid and it's not. They're really not the same thing.
I could tell you that our auditors are looking at some of that in some places, so as well. So and I think the places that have had problems are the ones where the one or both of those fees was unreasonable in the eyes of the auditor, at least.
Okay, great. And I think again, when it's about cost reasonableness, it's all about documentation. We have a question from Leslie that I want to ask for her, and then we can go back and check in on the phone. The question is, can a city or county use NSP3 home buyer assistance to an NSP2 funded home that has been developed by a developer? So can they layer?
Yeah, generally we've allowed that if it's in the same target area. That's particularly important, for an SP2, that they're not out of their target area. But as long as they have overlapping target areas, we've been okay with that. We've also allowed NSP3 or to pay for some of the administrative costs of 2, or vice versa. As long as they're serving the same.
And developer versus subrecipient in this particular instance doesn't make a difference, correct?
No.
Who's doing it? No, shouldn't matter.
Okay. I just wanted to be clear on that because she added that, so I was thinking maybe that was one of the questions there. Are there any questions on the phone right now, Zanetta?
There are no questions via the phone lines at this time.
Okay. We have a couple of folks that have raised their hands through the chat, but if you could just restate for them if they actually want to verbally ask their question, how they can do so. Zanetta?
There are no questions at this time.
Great. Could you please remind folks of how to ask a question through the phone line, please?
Yes, you may ask a question by pressing star 1 on your telephone keypad.
Great, thank you. And we do have a written question. This comes from Antoinette, and here we go. It's a little strong, a little long rather, sorry. It says, we received a draw from a CM, so I'm guessing that's contract manager or construction manager, for their developer who requested funds for both construction work and a deficit invoice. They prepared a quarterly profit and loss showing a loss for the quarter. We did not approve the deficit fee because the developer is already getting a developer fee on the project. But more importantly, we don't think it's an eligible expense. We told the CM we can't pay it just because the developer is losing money on the project. If they want to submit a change order because the project has additional legitimate eligible expenses, then that would be a different story. Were we correct?
Yeah, I agree with that. I mean, this is, developers like to have it both ways. They want to have those fees, and they want, don't want to have you in their face. But then, when they start losing money, they're your best friends. It's like, okay, guys, So, this is where, developer underwriting ought to be on one of those check boxes too. You got to really feel comfortable with your entity, but it's one thing to say that, and then it's another thing to see your project start going down the tubes because the developer's going down the tubes. So, we realize it's not always that simple in reality, but you're doing the right thing. If it's threatening the viability of your project, though, you shouldn't really necessarily care about your developer, but your project you do care about, and so you need to be thinking about ways to substitute a developer or get some other sort of assistance in there so that you don't lose your project.
Great, thank you for that. Do we have any questions on the phone at this time?
Is Leslie out of questions or what?
I'm double checking.
There are no audio questions at this time, but if you would like to ask a question, please press star 1.
John, you are correct. We are on E.
Oh my goodness! Come on, Leslie. What's wrong? Think a little harder.
She's trying to go easy on you today.
Oh, I see. We got a TA provider's call tomorrow, so I thought she's just cleaning up first.
Yeah, I'll make that one short and sweet.
We know, well, ladies and gentlemen, we know who this person is, and she's a friend of ours, so we're teasing her. So I don't know. So what are you looking at these days? What kind of problems are you working on, Dion? I know you got.
Hey, look, I just got a question. A follow-up on the construction management fee from Chris. What if the construction management fee is being charged when the construction manager? I think there's an answer he would like you to say. What if the construction management fee is being charged when the construction manager is part of the developer/contractor's staff? In that case, shouldn't the cost be a part of the contractor overhead and profit?
Not necessarily. I know you want me to say yes, but...
There should be a breakdown.
Are you checking that?
What the fee is covering, though.
Yeah,
so that you're not paying it twice.
Yeah, that's the better answer, I think. So, it doesn't matter where they put it. It matters what it is and what you're getting for it. So it's not so, if it's combined or if it's not combined. But there are going to be those kind of situations where it looks like double dipping, and it isn't always double dipping. So I just want you to be aware of that.
Well, I think that's a great point because many times folks don't ask or know that they're supposed to ask developers to break down that fee and that it's actually supposed to be covering specific costs. It's not just the set percentage that they get. So if they're not doing that, they need to. And if they are, then they need to also ask them to break out this additional fee so that they can make sure that there's no, counting the same expenses twice.
Right.
Yeah, it's not just this is not just a flat percentage fee that goes for, second summer homes?
Third summer home.
Third summer homes. Thirds are okay, seconds aren't?
I don't know.
That seems unfair. The second summer home market, but okay.
Where's the construction manager going to live?
These are complicated questions. Do we have any callers on the line?
There are no questions at this time.
Great, thank you. So Chris's was the last one in writing. John, in terms of what we're seeing on the ground, there are a couple of things that continue to come up, and I think one is disposition, which I know you all are seeing a lot of, and what's really interesting about that for us, and a struggle for a lot of the grantees that we're working with, is the properties that they bought further on in their programs. So, you kind of start out and you're on a learning curve, and over the course of 6 or 8 months, you really sort of get it down. And the properties that they bought, 6 or 8 months into their acquisition scurrying, they've been able to dispose of pretty successfully. And it is, generally speaking, is right now tending to be the ones that they bought at the beginning when they were desperate and they were worried about never being able to find anything, and they just bought whatever they could find, that they're having the most difficulty disposing of. And because they tend to be the ones that they've had the longest, the holding costs are really kind of getting out of hand. I mean, in some instances where they bought properties that didn't require that much rehab, the holding costs can almost exceed the rehab cost at this point.
Right.
And so they're really struggling with trying to figure out, what to do with them. In one instance, we actually had, and I know of, of this case, a grantee that was talking about, well, maybe we should just demolish the units and land bank the property because we don't know what else to do with them.
After they've rehabbed it?
Yeah.
Oh, no.
Well, that's what we said, but, I mean, it demonstrates that folks are really, they're having a tough time trying to figure out, under the premise of if we do it, they will come. That didn't quite work out.
Right.
But it tends to be the ones that they did at the beginning before they really understood their market and who their buyers were going to be.
Yeah, I think that's something that we've seen as well, and it makes sense. It's a little unfortunate, but I mean, again, let's think about that house is never going to bring any more money, and it's just going to cost you more. So you have every incentive to get rid of that for as little as you can, or as much as you can, but go down as far as you can just to get rid of it, because it's only going to continue to be more expensive as you go along. Again, you don't have to sell it for a dollar value below a certain level, but you can increase the subsidy rather substantially. Another case of somebody that I talked to was a community that has bought a lot of houses in a kind of bad area, or an area that they're having trouble attracting people to, and they looked at selling them. They were looking at selling them to for supportive housing or for special needs housing, and the area wasn't dangerous, but it's not as attractive as some other parts of town, and so broaden your thinking about who could use these houses, or even who the purchaser is. Maybe it's not an individual, maybe it's a nonprofit or something like that. We've had a lot of talk on disposition and a lot of strategies, and I think there's some good stuff up on the website, but those, we're worried about those, and if you're having problems with those, please, write into the on the resource exchange to request technical assistance, and we could get somebody out to help you work it through.
That's a great point. John, the only thing I would say in addition to that is on the opposite end of the spectrum. So they've got these properties that they've been holding forever, and then on the opposite end, what they're finding is that their markets, and we talked about this a little bit in terms of amending your target areas, their markets are shifting In Florida during the problem-solving clinics, we called it the investors have landed, right? So they're being sort of priced out of their original target areas. And so with the push towards 100% expenditure, they're trying to do all of their final acquisitions, and they're having some problems identifying properties that, that are in those target areas because, when they blinked, it moved. So I heard the conversation about amending them, and it sounds like it's going to take, I think, David, did you say earlier they should plan for that process to take about 6 weeks?
Yeah.
That's what John was saying.
Yeah, I think for a local, for NSP 1 and 3, I think that's probably a realistic amount of time. Maybe you could do it a little faster.
If you need a substantial amendment, yeah.
Mm-hmm.
Yeah, I mean, you still have to go through your citizens. If you don't have to go through your city council or something like that, then it could probably be, maybe half that amount of time.
Right. So I was bringing that back up just to reinforce to folks that if acquisition is a problem for you right now, then you should really move forward with, addressing your target area needs or whatever that is, because if it's going to take time to get those changes approved, then you still have to go out once those changes are approved and identify the properties and do that acquisition. So in a lot of instances, we've been working with folks on scheduling, backing their dates out to figure out basically, when they needed to do things by in order to get their money spent. And it turns out that in almost every instance, the day they needed to start was a date in the past.
Right. Yeah, I mean, I agree with you that it makes more sense to get into a new target area that's a better area to sell houses in. But I mean, if the investors are chasing you around, they're moving in that direction too. So, but I definitely agree with you that it's a bad policy to spend your money fast on bad projects because you'll just be stuck with them. So, I don't know. There's maybe not any perfect way out of this, but we'll see in the closeout guidance. But I mean, in NSP 1 and 3, I don't believe that we are required to recapture funds. We're not required to, but I don't know. I don't know what we'll do. So, but you should be talking to either your field office or to us or to your TA provider, or if you don't have a TA provider, to us about getting one. Because, I mean, real estate's a slow process, and, I have to say I feel a little guilty because I know that in the first part of NSP 1, we pushed everybody towards the areas of greatest need because that's what the legislation said. And then I think that people took that to mean we have to go into the worst part of town. And that's a hard part of town to get out of. So, I heard someplace in Florida, I don't know, maybe a year ago about, somebody that was doing a home, for, like $1 rent for, police and firemen and that sort of thing, So you might need to get creative with those difficult properties. But I don't think they're going to get a whole lot less difficult. So, the sooner you can figure out a strategy, the better off you're going to be.
So we don't have any more written questions. I'm going to check in one more time with Zanetta and see if we have anybody on the phone.
We have no further questions from the phone line.
Okay, great. John and David and Hunter, would you like to make any closing statements or remarks at this point? We've got about 20 minutes left in the technical time for the webinar.
Yeah, that's fine. Unless Leslie comes up with another question, I think we're ready to rest our case. So.
Okay. I'm not seeing. There's nothing else coming through the system. What we would like to hold on. Somebody just raised their hand, but I need for them to actually ask a question. Let me see if I can get this question. And I've got hands raising, but I need actual questions asked. So the other thing that we would like to do is just make sure that folks are aware of the link to the SurveyMonkey, which is the evaluation tool for these webinars. At the end of the webinar, we would ask you to actually click through to the link and fill it out while it's still fresh in your mind. Kathy's pulling it up so that you can see. Really, it's just, you know, who you are.
Dion, folks can actually fill it out right there in the live meeting client right now. Everybody has a unique connection to that website, so you can fill it out right now while we're waiting for those last questions to come in.
Yeah. Oh, I like that.
Good.
Perfect.
Good. I did think of one thing that I wanted to mention, that we're going to be putting out a short notice out that reminds all NSP grantees that expenditures are measured in your quarterly progress report. And so we went through this with the NSP2 grantees that had to demonstrate 50% expenditure last February. NSP1 grantees only have had to demonstrate obligations so far. We use the drawdown reports through that track through DRGR as a pretty close approximation of expenditures, but actual expenditures have to be reported in the quarterly progress report, and we're asking you to take a look at that and try to update that for this coming quarter. NSP 1 and 3 have to also do their QPRs by the end of this month, and if you could be, particularly careful about recording accomplishments. We think there's under-reporting going on. We think there's more houses occupied than we're seeing. But next spring, when we start to look at expenditures, we're going to be looking in the QPR for them. So you need to get on that. Now, the good news is that the way that we defined expenditures basically means that most grantees that use the accrual system of accounting will in many cases have more expenditures than they've actually drawn, because you have an expenditure when you've received an invoice. That's considered an expenditure in accrual accounting. You have an expenditure when your admin or your activity delivery costs have been performed, even if they haven't been paid yet. So in those cases, it actually ended up being a little bit better deal for people. So the notice that Jennifer put together should be going out today or tomorrow, and it defines these expenditures and just alerts you that this is going to happen through the QPR. So we didn't want to catch you by surprise the way some of the NSP2 grantees got caught last spring.
Great, thank you. We do have one more question that has come through. Let me go ahead and read it. This is from Antoinette. We acquired a loan in 2007 to be used as capital for the development of housing affordable to low and moderate income home buyers, and another loan to purchase land to develop the new homes for low to moderate income home buyers. We're currently using NSP2 funds to build new construction homes on this land. Can the interest and principal charged for these loans be paid by NSP2?
Well, probably after after you committed the NSP2 funds. I don't think we're not going to go back to 2007 with you on it. That'd be my first.
Yeah, I mean, the other thing I'd look at is when the properties were acquired with the loans, were they acquired with the intent to use NSP, right? So was the environmental review done? Were all of the other applicable rules followed, Davis-Bacon and so on? Right?
In 2007?
Well,
were the loans gotten with the intent to use them for NSP?
Well,
but I thought you said there was another loan. One was 2007, and then there was another one.
Yeah, it doesn't say when the second one was.
Okay.
Well, so I think you can fund
the rehab.
construction, the rehab, and do an environmental review on that piece of it.
Well, these are new construction.
Right.
Right, yeah. So you can pay for the new construction, but the loans that you use to acquire the land, I'm not seeing how that's eligible.
You'll get that money back when you sell the units.
The principal, right, but not necessarily the interest.
Well, yeah, I mean, I just don't see how we get into that until, after the NSP2 application was approved and, you selected projects. I assume this is vacant land, and so it's qualified under eligible use E. You've already acquired it, so we can't help you there. I don't know about the ongoing, interest carrying charges after a certain point, but if the acquisition wasn't part of NSP, I don't see how the carrying charges can be part of it. I can imagine that the new construction and the construction period interest after the NSP commitment and after the NSP environmental review was done could qualify. But that's kind of a, I'm sure there's a lot of more variables, but I think we're limited to what happens after NSP came along and what they did with the how they treated the project. If all they want to do is pay the interest, I don't know. So maybe she should write that in.
That's violating the notice, which states that you can't use NSP funds to repay yourself. Previous acquisition.
So, John and David, are you suggesting that she should submit that one through the Ask a Question through the NSP Resource Exchange?
Yeah.
And that way she can get a written answer?
Yeah, because, we need a few more details to really understand the circumstances, and we could give you kind of a rough estimate, which we're doing, which is to say probably not the land and the interest that went with that, and probably only things that happened after the NSP grant was awarded and after any environmental review was done, which would probably be the new construction. But that's a kind of gross split on that. If she needs a finer tune, she should write it in.
Thank you. And another comment actually came in from Chuck suggesting that not only is that something to be determined, but also once the sales proceeds are in, you'd still have to look at the proration of those between the loan and the NSP commitment. So it's not even necessarily all going back to cover the cost of those original loans.
Right.
Yeah, you prorate. So you could get something back. Whether that something is enough to retire the loan, I can't say.
Right.
But
great. Let me just double check. Are there any calls on the line right now on the phone?
There are no questions at this time, but if you would like to ask a question, please press star 1.
So, John and David and Hunter, I think we are finished for the afternoon. I'm not seeing any other questions coming. No other last-minute questions or comments seem to be appearing as a result of my suggesting that. So, we can probably. Pardon?
The Ask a Question line is always open. So.
And when is the next? Do you happen to know when the next open forum Q&A is? Are you all doing them about once a month now?
Yeah, it's second week of August or something like that, I think. So.
Okay. And then next week is the subrecipient and developer webinar that folks will probably want to listen in on as well.
Hey, the 31st is the trust is doing one on the Attorney General settlement, so people might be interested in that.
Yeah. I should also mention that our Environmental Review Office is starting up a webinar series tomorrow, and they'll be going through strategies for approaching the environmental review process.
Yeah, and we've seen through the clinics that there's a lot of new staff out there, so or at least new to this program. So this is a good opportunity, and the environmental review process is something that cuts over to CDBG and other programs. So take advantage of those things.
That's great. That's great to know. Is that going to come out? Is that coming out through the NSP listserv for folks to be able to register for it?
Yeah. I know that we've been promoting those that way. So
perfect.
They should be listed on our calendar, but I'm not. I mean, I hope they are. I'm not positive.
Well, thank you, everybody, and John and David and Hunter, thank you for joining us this afternoon. I hope that it cools down below 100 sometime before the sun sets for you.
So why? Thank you.
And everybody else, have a great rest of your day.
Thank you. Bye.
All right. Thanks so much. Take care.
This concludes today's teleconference. You may now disconnect at this time.
Great. Thank you.
You're welcome, ma'am. Have a great day.
You too.
Bye-bye.